Michael had a 761 credit score, perfect by all traditional measures, but it still cost him $35,000 more than his coworker over the life of his mortgage. How is that possible? On paper, he should have been the ideal borrower, never missing a payment, paying off credit cards in full every month, earning $78,000 a year, and holding the same job for 4 years. Everything looked perfect. Yet, when he applied for a mortgage, the bank gave him a higher interest rate than his coworker, who had lower credit, less job stability, and almost the same income. The reason wasn't mistakes on his part. It was an invisible system quietly assessing him, one he had no access to and never knew existed. Today, we're uncovering the hidden world of the invisible score and why your credit score may be lying to you. The borrower who did everything right. Michael's story is the classic example of what many call the perfect borrower paradox. You do everything by the rules. You pay on time, keep your credit utilization low, maintain stable employment, and still find yourself paying more than someone who seems less financially responsible. In traditional finance, the FICO score is supposed to summarize your creditworthiness. It considers 5 factors: payment history, amounts owed, length of credit history, new credit, and credit mix. Michael excelled in all of them. Yet, his FICO score was only a part of the story. Despite being responsible, organized, and financially stable, his mortgage costs were higher. This highlights the uncomfortable reality. The number you see on Credit Karma or your monthly credit report isn't the full picture. There is a shadow evaluation happening behind the scenes, one that traditional credit scores do not capture. The invisible score you never see. Banks and lenders now rely on proprietary scoring models that incorporate hundreds of data points, many of which are invisible to consumers. Your FICO score is the decoy, a number that makes the system appear transparent. In reality, your financial behavior is constantly being analyzed in ways you cannot see or control. Think of your invisible score as a ghost following you. Every purchase, every transaction, every paycheck deposit is silently observed and interpreted. A single data point could move your score up or down without you ever knowing. The algorithms don't judge morality, they judge patterns, stability, and risk probability. For example, according to a 2023 Consumer Financial Protection Bureau report, major financial institutions consider over 200 different variables when making lending decisions. Most of these variables are never disclosed to the consumer. Many have nothing to do with traditional credit history, yet they can drastically affect whether you get approved or the interest rate you are offered. Alternative data and behavioral analysis. This is where it gets intricate. Banks aren't just looking at the numbers on your credit report. They analyze patterns, behaviors, and even psychological cues to assess risk. Transaction patterns. Where and when you spend money matters. Buying a sofa from a high-end retailer signals stability to an algorithm. Buy the same sofa from a rent-to-own store, and it may signal risk. Timing also matters. Paying bills early versus late, depositing paychecks consistently versus irregularly, and making purchases during business hours versus late at night all feed the model. Alternative data. Lenders increasingly purchase data from third-party aggregators. This can include online shopping history, education background, employment patterns, and even location data. Companies like Zest AI and Upstart openly use thousands of variables to predict creditworthiness, incorporating data that goes beyond what you expect. Psychological profiling. Algorithms observe spending velocity, or how fast you spend your money after it lands in your account. Do you blow through your paycheck in 2 days or pace it out over the month? Do you have recurring subscriptions that show consistency, like gym memberships or automatic savings transfers? Or are all your purchases one-off and erratic? These patterns help algorithms assess planning, stability, and predictability. Combining these factors, banks construct a score you never see, one that can override your perfect FICO. Algorithmic bias in action. The invisible score isn't just secret, it can be unfair. Even when algorithms avoid explicit demographic information like race or income, they often rely on proxies that correlate with them. This can unintentionally create bias. Here's a concrete example. 2 borrowers earn the same salary, owe the same amounts, and have similar credit histories. One shops at premium retailers, the other at discount stores. The algorithm may see the discount shopper as a higher risk and charge a higher interest rate. That tiny difference, a few percentage points, can translate into tens of thousands of dollars over a mortgage or years of credit debt. Similarly, financial behaviors common in lower-income communities like using prepaid cards, making small frequent deposits, or shopping at discount stores can inadvertently signal risk to an algorithm trained mostly on higher-income data. This is the hidden inequality baked into the system. The real financial cost over a lifetime. The stakes are enormous. Consider Michael again. His invisible score added half a percentage point on his mortgage on $350,000. That alone will cost over $35,000 in interest. But mortgages are just the tip of the iceberg. A lower invisible score can mean higher credit card rates by several points. On an $8,000 balance, that could cost hundreds per year. Higher auto insurance premiums. In states allowing credit-based pricing, the difference between high and low scores can exceed $1,000 annually. Larger apartment security deposits or worse lease terms, job rejections in industries that screen financial backgrounds. Cumulatively, over a lifetime, the invisible score can silently transfer hundreds of thousands of dollars from you to financial institutions, based on entirely data you didn't even know was being collected. How to regain control. You can't opt out of the system, but you can become proactive. Stabilize transaction patterns, set up automatic payments for recurring bills, spread spending across the month, and avoid late-night impulse purchases. Consistency signals reliability. Be mindful where you spend money. When choices exist, prefer merchants and services that are less likely to trigger negative algorithmic interpretations. Minimize financial chaos. Close unused accounts, consolidate banking relationships, and avoid frequent credit applications. Volatility can be interpreted as risk. Advocate for transparency. Request explanations for adverse lending decisions. Support consumer protections that require lenders to disclose more about the data and algorithms they use. These steps won't eliminate the invisible score, but they allow you to influence how it interprets your financial behavior. Your credit score is the decoy. The invisible score is the real game, and knowledge is the only way to level up. Michael followed all the rules he knew about and still lost tens of thousands of dollars. He's not unusual, he's normal. The invisible score is being calculated for you right now with every transaction, every swipe, every paycheck deposit. You cannot hide from it, but you can stop being blind. Understanding it is the first step towards controlling the financial life it quietly shapes. Knowledge is power, awareness is freedom, and in a system designed to keep you in the dark, understanding the invisible score is your only chance to play by the hidden rules.